The collapse of Canada's housing market has officially begun, and what you're about to discover will fundamentally change how you view Canadian real estate forever. Just don't miss number 5 and number 2, because what's happening in those cities will absolutely shock you and reveal the true extent of this unprecedented market crash that's sweeping across the nation. Number 10. Windsor, Ontario. Windsor is experiencing something that real estate experts never saw coming. A complete breakdown of market confidence that's sending shockwaves through southwestern Ontario. Home prices in Windsor have dropped by 22% from their peak, bringing the average home price down from $485,000 to just $378,000. But here's what makes Windsor's collapse so particularly devastating. This was supposed to be Canada's affordable housing success story. Windsor sits right across from Detroit, and for years, it marketed itself as the perfect solution for families priced out of Toronto's expensive market. The city offered reasonable home prices, decent employment opportunities in manufacturing, and a lower cost of living that seemed sustainable. But what nobody anticipated was how quickly Windsor's advantages could become liabilities when the broader market started collapsing. The automotive industry changes that have rocked the region are creating massive uncertainty about long-term employment prospects. Families who move to Windsor for manufacturing jobs are now questioning whether those jobs will even exist in 5 years. Meanwhile, the city's proximity to Detroit, once seen as an advantage for cross-border opportunities, has become a reminder of what happens when industrial cities face economic decline. But here's the most concerning part about Windsor's situation. The demographic driving the collapse isn't just local buyers. International investors and Toronto refugees who bought Windsor properties as affordable alternatives are now trying to exit the market simultaneously, creating a supply glut that's pushing prices down even faster. The city is dealing with a perfect storm of economic uncertainty, job market instability, and investor flight that's creating one of the most dramatic price corrections in Canadian real estate. For Windsor homeowners, this represents a devastating loss of what was supposed to be their most stable investment. But what's happening in Windsor might just be a preview of what's coming to other mid-sized Canadian cities that built their housing markets on industrial foundations. Speaking of industrial foundations crumbling, our next city shows how even energy-rich regions aren't immune to this collapse. Number 9. Calgary, Alberta. Calgary's housing market collapse is rewriting everything we thought we knew about energy boom economics and real estate stability. Home prices in Calgary have dropped by 18% from their peak, with the average home price falling from $587,000 to $481,000. But what makes Calgary's situation so shocking is that this is happening during a period when oil prices have been relatively stable and the energy sector seemed to be recovering. Here's what nobody saw coming about Calgary. The city's real estate market had become completely dependent on a boom and bust mentality that finally ran out of steam. For decades, Calgary attracted workers and families with the promise of high-paying energy jobs and affordable housing compared to Toronto and Vancouver. The city's economy seemed recession-proof, and real estate was considered a safe long-term investment. But Calgary is now facing a demographic crisis that's unlike anything the city has experienced before. Young professionals are leaving for Toronto and Vancouver despite the higher costs because they want career diversification and urban amenities that Calgary can't provide. Meanwhile, established residents are reaching retirement age and looking to cash out their real estate investments, creating a supply surge just as demand is weakening. The energy sector changes that everyone thought would boost Calgary's real estate market are actually having the opposite effect. As energy companies embrace remote work and automation, they need fewer Calgary-based employees. The high-paying jobs that justified Calgary's real estate prices are disappearing, and they're not being replaced by equivalent opportunities in other sectors. What's particularly alarming about Calgary's price drops is how they're affecting the rental market as well. Landlords who bought investment properties during the boom years are now facing negative cash flow as rental demand weakens and property values decline. Some are choosing to sell at a loss rather than continue subsidizing their investments, adding even more supply to an already oversupplied market. For Calgary residents, this collapse represents more than just lost equity. It's forcing a complete rethinking of the city's economic future and what that means for real estate values. The question everyone's asking is whether Calgary can reinvent itself quickly enough to prevent even steeper price declines. But if Calgary's energy-dependent economy is struggling, wait until you see what's happening in our next city, where the problems run even deeper. Number 8. Edmonton, Alberta. Edmonton is experiencing a housing market collapse that's so severe and unexpected that it's forcing economists to completely reconsider their predictions for Canadian real estate. Home prices in Edmonton have plummeted by 24% from their peak, bringing average home prices down from $421,000 to just $320,000. That's a price level Edmonton hasn't seen since 2016, and there's no sign that the decline is slowing down. What makes Edmonton's collapse particularly shocking is that this city was supposed to be insulated from the housing market problems affecting other Canadian centers. As Alberta's capital and home to major government employment, Edmonton seemed to have the economic diversity and stability that other energy-dependent cities lacked. The presence of the University of Alberta, government jobs, and a growing tech sector was supposed to provide a foundation that could weather economic storms. But here's what's really happening in Edmonton that reveals the depth of Canada's housing crisis. Even government-anchored economies aren't providing the stability they once did. Provincial budget pressures are leading to government job cuts and hiring freezes, eliminating one of the key pillars of Edmonton's economy. The university is dealing with funding cuts that are affecting both employment and student enrollment, reducing demand for housing near campus. The demographic trends in Edmonton are particularly concerning because they represent a broader pattern affecting mid-sized Canadian cities. Young graduates are leaving for Toronto, Vancouver, or even Calgary, seeking better career opportunities and urban amenities. Meanwhile, the baby boomer generation is beginning to downsize or move to warmer climates, creating a supply surge just as demand from younger buyers is weakening. Edmonton's rental market is also collapsing, with vacancy rates reaching levels not seen since the 1990s. Landlords are dropping rents by 15 to 20% just to fill units, and many are choosing to sell their investment properties rather than deal with negative cash flow. This is creating a vicious cycle where declining rental income reduces property values, which in turn makes real estate investment even less attractive. For Edmonton homeowners, this collapse is particularly devastating because many bought their homes expecting steady, if not spectacular, appreciation based on the city's government and university anchors. Instead, they're facing the reality that even traditionally stable economic foundations can't support real estate values in today's market. The psychological impact of Edmonton's collapse is spreading to other mid-sized Canadian cities, as buyers begin to question whether any market outside of Toronto and Vancouver can provide long-term real estate stability. But as we'll see with our next city, even that assumption might be wrong. Number 7. Halifax, Nova Scotia. Halifax is experiencing a housing market collapse that's stunning real estate experts because it represents the failure of one of Canada's most promising regional growth stories. Home prices in Halifax have dropped by 31% from their peak, bringing average prices down from $548,000 to $378,000. What makes this collapse so significant is that Halifax was supposed to be Canada's next big real estate success story. Just 3 years ago, Halifax was being marketed as the perfect alternative to Toronto and Vancouver's expensive markets. The city offered maritime charm, a growing tech sector, reasonable commute times, and what seemed like sustainable real estate prices. Young professionals were flocking to Halifax, international students were choosing local universities, and the city's population was growing at its fastest rate in decades. But here's what nobody anticipated about Halifax's rapid growth. The city's infrastructure and housing supply couldn't keep up with demand, creating artificial price inflation that was unsustainable once the broader market started cooling. The rapid price increases that made Halifax look like a success story were actually creating a bubble that was destined to burst once external economic pressures mounted. Halifax's economy, while more diverse than purely resource-dependent cities, still relies heavily on government employment, defense spending, and educational institutions. As federal budget pressures mount and defense spending priorities shift, the economic foundation supporting Halifax's real estate market is weakening. Meanwhile, the tech sector growth that was supposed to drive long-term demand has slowed significantly as companies embrace remote work and reduce their physical footprint. The demographic that was driving Halifax's real estate boom, young professionals seeking an alternative to expensive central Canadian markets, is now reconsidering their choices. Many are discovering that Halifax's job market can't support the lifestyle they expected, while others are finding that the cost savings compared to Toronto and Vancouver have evaporated as local prices rose and services remained limited. What's particularly concerning about Halifax's collapse is how it's affecting the broader maritime real estate market. The city was supposed to be the region's economic engine, driving growth and real estate appreciation throughout Nova Scotia and the broader Maritimes. Instead, Halifax's problems are spreading to smaller maritime communities, creating a regional real estate crisis that's affecting hundreds of thousands of homeowners. For Halifax residents who bought during the boom years, this collapse represents a devastating loss of equity and a complete rethinking of their financial future. Many moved to Halifax specifically to escape the high real estate costs of central Canada, only to discover that they've ended up in an even more precarious situation. The ripple effects of Halifax's collapse are already being felt in other regional Canadian centers as buyers become skeptical of growth stories and alternative market narratives. This is contributing to the broader collapse of confidence that's affecting real estate markets across the country. But what's happening in our next city shows that even established, diversified economies aren't immune to this crisis. Number 6. Hamilton, Ontario. Hamilton represents one of the most shocking chapters in Canada's housing market collapse, because this city was supposed to be the perfect example of sustainable real estate growth outside of Toronto's expensive core. Home prices in Hamilton have crashed by 16% from their peak, bringing average prices down from $847,000 to $711,000. But what makes Hamilton's collapse so particularly devastating is how it reveals the fundamental weakness underlying Canada's entire real estate market. Hamilton spent years marketing itself as Toronto's affordable alternative, close enough for commuters but far enough away to offer reasonable housing, costs, and a better quality of life. The city attracted young families, first-time home buyers, and investors who believed that Hamilton's proximity to Toronto and growing economy would support steady real estate appreciation. The narrative was compelling: get more house for your money while still having access to Toronto's job market and amenities. But here's what's really happening in Hamilton that exposes the depth of Canada's housing crisis. The work-from-home revolution has completely undermined the value proposition that drove Hamilton's real estate boom. When people don't need to commute to Toronto regularly, the premium they're willing to pay for Hamilton's location disappears. The city is left competing on its own economic merits, and those merits aren't strong enough to support the real estate prices that commuter demand had inflated. Hamilton's industrial heritage, once seen as a strength that provided economic diversity, is now becoming alienability as manufacturing continues to decline and environmental concerns affect property values in certain areas. The steel industry that anchored Hamilton's economy for generations is facing long-term challenges that are creating uncertainty about the city's economic future. The demographic trends in Hamilton are particularly troubling because they represent what's happening across the Greater Toronto Area's outer regions. Young families who move to Hamilton for affordability are discovering that they've sacrificed urban amenities and career opportunities without achieving the financial benefits they expected. Meanwhile, empty nesters who stayed in Hamilton are beginning to question whether their real estate investments will provide the retirement security they were counting on. Hamilton's rental market is also experiencing significant stress, with rental rates dropping as demand weakens and supply increases from investors looking to exit the market. This is creating a vicious cycle where declining rental income reduces property values, making real estate investment even less attractive and accelerating the supply increase. For Hamilton homeowners, this collapse is particularly painful because many bought their properties believing they were making a smart financial decision by choosing an affordable alternative to Toronto. Instead, they're discovering that they've sacrificed lifestyle and convenience without achieving financial security. The psychological impact of Hamilton's collapse is affecting real estate markets throughout the Greater Toronto Area, as buyers begin to question whether any suburb or satellite city can provide long-term real estate stability. This is contributing to the broader collapse of confidence that's driving down prices across Ontario. But Hamilton's problems pale in comparison to what's happening in our next city, where the collapse is so severe that it's changing how Canadians think about real estate investment entirely. Number 5. Montreal, Quebec. Hold on to your seats because what's happening in Montreal is going to completely shatter everything. You thought you knew about Canadian real estate stability, and this is exactly why I told you not to miss this one. Montreal is experiencing a housing market collapse that's so dramatic and unexpected that it's forcing real estate experts to completely reconsider their understanding of what drives property values in Canada. Home prices in Montreal have crashed by an absolutely staggering 28% from their peak, bringing average prices down from $612,000 to just $441,000. But here's what makes Montreal's collapse so extraordinary and shocking. This was supposed to be Canada's most stable and rational real estate market, insulated from the speculation and overheating that affected Toronto and Vancouver. Montreal had everything going for it that real estate experts said mattered for long-term stability. The city had reasonable prices compared to other major Canadian centers, a diverse economy anchored by aerospace, technology, and financial services, world-class universities attracting international students, and a unique cultural appeal that drew both domestic and international buyers. This was the market that economists pointed to as an example of how Canadian real estate should work. But what's really happening in Montreal reveals something terrifying about the current market that nobody wants to acknowledge. Even fundamentally sound real estate markets can collapse when buyer psychology shifts and economic uncertainty takes hold. Montreal's collapse isn't about overvaluation or speculation gone wrong. It's about a complete loss of confidence in real estate as a safe investment, even in markets that seemed perfectly positioned to weather economic storms. The demographic trends driving Montreal's collapse are particularly concerning because they represent forces that are affecting cities across Canada. Young professionals are leaving Montreal for Toronto and Vancouver, despite the higher costs, seeking better career opportunities and higher salaries that they believe will offset housing expenses. Meanwhile, the international buyers who had been supporting Montreal's market are pulling back due to economic uncertainty and currency concerns. Montreal's rental market is experiencing an unprecedented collapse, with vacancy rates reaching levels not seen since the 1990s, and rental prices dropping by double digits in many neighborhoods. Landlords are discovering that the investment properties they bought during the boom years are now generating negative cash flow, and many are choosing to sell at significant losses rather than continue subsidizing their investments. What's most disturbing about Montreal's situation is how it's affecting Quebec's broader real estate market and the province's economic confidence. Montreal was supposed to be the economic engine driving growth throughout Quebec, but instead its real estate collapse is spreading uncertainty and declining values to smaller Quebec cities and rural areas. For Montreal homeowners, this collapse represents more than just lost equity. It's a fundamental questioning of real estate as a wealth-building strategy and retirement planning tool. Many residents who bought their homes as long-term investments are now facing the reality that their most significant asset has lost nearly 30% of its value in less than 2 years. The psychological impact of Montreal's collapse is rippling through real estate markets across Canada, as buyers in other cities begin to question whether any market is truly safe from dramatic price corrections. This is contributing to the wait-and-see attitude that's affecting real estate sales and prices from coast to coast. But if Montreal's supposedly stable market can collapse so dramatically, what does that mean for the cities that were already showing signs of weakness? Our next city provides a terrifying answer to that question. Number 4. Kitchener, Waterloo, Ontario. Kitchener-Waterloo represents one of the most devastating chapters in Canada's housing market collapse because it exposes how even technology-driven growth stories can crumble when broader economic pressures mount. Home prices in the region have plummeted by 33% from their peak, bringing average. But here's what's really happening in Kitchener-Waterloo that reveals the fragility of technology-dependent real estate markets. The tech sector's embrace of remote work has completely undermined the location-based value proposition that drove the region's real estate boom. When software developers and tech professionals can work from anywhere, they no longer need to pay premium prices to live near tech company offices or university campuses. The demographic that was driving Kitchener-Waterloo's real estate success, young tech professionals with high incomes and growth expectations, is now questioning whether the region offers enough lifestyle and career benefits to justify its real estate costs. Many are discovering that they can earn Toronto or Vancouver salaries while living in cheaper locations, or alternatively, they can move to major tech hubs that offer better career opportunities and urban amenities. Kitchener-Waterloo's rental market has been devastated by this shift, with rental prices dropping by 25%. Properties that sold for over $3 million are now struggling to find buyers at $2 million. For Vancouver homeowners, this collapse represents a catastrophic loss of wealth that's affecting retirement plans, family finances, and long-term life decisions. Many residents who viewed their homes as their primary financial asset are now facing the reality that they've lost more money in real estate than they've earned in their careers. The psychological impact of Vancouver's collapse is spreading across Canadian real estate markets, as buyers in other cities realize that if Vancouver can see 34% price drops, no market is truly safe from dramatic corrections. This is contributing to the wait-and-see attitude that's affecting real estate sales and prices from coast to coast. But Vancouver's problems are nothing compared to what's happening in our number 2 city, which you absolutely cannot miss, because what's occurring there is so shocking that it's going to change everything you thought you knew about Canadian real estate. Number 2, Toronto, Ontario. Get ready. Because what's happening in Toronto is going to completely destroy everything you believed about Canadian real estate stability. And this is exactly why I told you not to miss this one. Toronto is experiencing a housing market collapse that's so catastrophic and unprecedented that it's forcing economists, real estate professionals, and government officials to completely reconsider everything they thought they knew about Canada's economic foundation. Home prices in Toronto have crashed by an absolutely mind-blowing 37% from their peak, bringing the average home price down from $1.65 million to just $1.04 million. That's a loss of over $610,000 per home, representing the complete evaporation of wealth for hundreds of thousands of families who viewed their Toronto real estate as their primary financial asset and retirement security. But here's what makes Toronto's collapse so extraordinary and terrifying. This wasn't supposed to be possible. Toronto was Canada's economic engine, the financial capital, the city with the most diverse economy and the strongest job market. It had everything that real estate experts said mattered for long-term stability: population growth, international immigration, major corporate headquarters, and a reputation as one of North America's most important business centers. Toronto's collapse is revealing something that nobody in the real estate industry wants to acknowledge. Even the strongest economic fundamentals can't support real estate values when they become disconnected from local incomes and economic reality. The average Toronto home price had reached levels that required household incomes of over $200,000 to afford, pricing out not just entry-level buyers but also established professionals, government employees, and even many people working in the financial district. What's really happening in Toronto exposes the fundamental weakness that was hidden beneath decades of price appreciation. The city's real estate market had become completely dependent on speculation, international investment, and debt-fueled buying that was unsustainable once economic conditions changed. When interest rates rose and international buyers pulled back, there wasn't enough local demand to support the inflated values. The demographic trends driving Toronto's collapse are particularly alarming because they represent a complete reversal of the population growth that supported real estate values for decades. Young professionals are leaving Toronto for cheaper cities, even if it means lower salaries, because they've concluded that Toronto's costs have made it impossible to build wealth or achieve financial security. Meanwhile, established residents are cashing out and moving to smaller cities where their Toronto equity can provide a better lifestyle. Toronto's rental market has collapsed alongside the sales market, with luxury condos that were renting for $3,500 per month now sitting empty at $2,200 per month. The Airbnb market has completely evaporated as tourism declined and regulations tightened, forcing thousands of investment properties back onto the rental and sales markets simultaneously. What's most disturbing about Toronto's situation is how it's affecting Canada's broader economic confidence and international reputation. Toronto was supposed to be Canada's success story, the city that proved Canadian real estate could compete with global markets. Instead, its collapse is being watched by international investors and economists as a case study in how even the strongest markets can experience devastating corrections. For Toronto homeowners, this collapse represents more than just lost equity. It's a complete destruction of their financial future and retirement plans. Many residents stretched to afford Toronto real estate believing it was the only way to build wealth in Canada, only to discover that they've lost more money than they could earn in years of employment. The psychological impact of Toronto's collapse is devastating real estate markets across Canada, as buyers realize that if Toronto can see 37% price drops, absolutely no market is safe from catastrophic corrections. This is creating a national crisis of confidence that's affecting real estate from coast to coast. But if Toronto's collapse is shocking, what's happening in our #1 city is going to leave you speechless and potentially change your entire understanding of where Canadian real estate is headed. Number 1. London, Ontario. Here we are at number 1. And what's happening in London, Ontario is so catastrophic and unexpected that it represents the complete collapse of everything Canadians believed about real estate as a safe investment and wealth-building strategy. London is experiencing the most severe housing market crash in Canadian history, with home prices plummeting by an absolutely devastating 41% from their peak, bringing average prices down from $728,000 to just $429,000. What makes London's collapse deserve the #1 spot isn't just the magnitude of the price decline. It's what London's situation reveals about the fundamental breakdown of Canada's entire real estate market and economic foundation. London was supposed to be the perfect example of sustainable Canadian real estate, a mid-sized city with reasonable prices, steady economic growth, and the kind of fundamentals that real estate experts said would provide long-term stability. London had everything that economists said mattered for real estate success: a major university providing steady demand, diverse employment including healthcare, education, and financial services, reasonable commute access to Toronto for those who needed it, and home prices that seemed sustainable based on local incomes. This was the market that financial advisors pointed to when they told clients that Canadian real estate was a safe long-term investment. But London's collapse is exposing the terrifying reality that no Canadian real estate market, regardless of how reasonable or well-founded it appears, is immune to the psychological and economic forces that are destroying property values across the country. When buyer confidence collapses and economic uncertainty takes hold, even the most sensible markets can experience devastating price declines that wipe out decades of wealth accumulation. What's really happening in London reveals the depth of Canada's real estate crisis and why it's spreading to markets that nobody expected to be affected. The university that was supposed to provide steady housing demand is dealing with international student restrictions and funding cuts that are reducing enrollment. The healthcare and government jobs that anchored the local economy are facing budget pressures and hiring freezes. Even the proximity to Toronto, once seen as an advantage, has become irrelevant as remote work reduces the need for geographic access to major employment centers. London's demographic trends are particularly alarming because they represent what's happening across mid-sized Canadian cities that were supposed to be immune to the problems affecting major urban centers. Young graduates are leaving London for opportunities in other countries rather than other Canadian cities, recognizing that Canada's entire real estate market has become disconnected from economic reality. Meanwhile, established residents are questioning whether their real estate investments will ever recover, leading to a psychological shift that's accelerating the market decline. The rental market in London has been devastated, with vacancy rates reaching historic highs and rental prices dropping by 30% in many areas. Landlords who bought investment properties expecting steady returns from students and young professionals are discovering that their tenants are leaving the city entirely, choosing to live with family or relocate to other countries rather than continue paying Canadian housing costs. What's most terrifying about London's collapse is what it signals about the future of Canadian real estate and the country's economic foundation. If a reasonable, well-diversified market like London can see 41% price declines, it suggests that Canada's entire real estate market was built on unsustainable foundations that are now crumbling simultaneously across the country. For London homeowners, this collapse represents the complete destruction of their financial security and life plans. Many residents who bought homes as long-term investments and retirement planning tools are now facing losses that will affect their financial future for decades. The psychological trauma of watching their most significant asset lose nearly half its value is creating a crisis of confidence that extends far beyond real estate into fundamental questions about Canada's economic future. London's collapse is being watched by real estate experts and economists around the world as a case study in how quickly and completely real estate markets can collapse when buyer psychology shifts and economic fundamentals are revealed to be weaker than anyone realized. The city that was supposed to represent sustainable Canadian real estate has instead become the symbol of the country's housing market collapse. The ripple effects of London's situation are spreading across Canada as buyers in other mid-sized cities realize that if London can experience such devastating price declines, their own markets could be next. This is contributing to a national paralysis in real estate activity as buyers and sellers alike wait to see how much further prices might fall. So there you have it, the 10 Canadian cities where the housing market collapse has hit hardest, from Windsor's 22% decline to London's catastrophic 41% crash. What we're witnessing isn't just a normal market correction, but a fundamental breakdown of the economic and psychological foundations that supported Canadian real estate for decades. These price declines reveal a market that had become completely disconnected from economic reality, supported by speculation and debt rather than sustainable demand. What do you think about these dramatic price changes and what they mean for Canada's economic future? Are these collapses creating opportunities for new buyers, or are they warning signs of even bigger problems ahead? Let us know your thoughts in the comments, and tell us which city's situation surprised you the most and why. If you found this analysis helpful and want to stay updated on Canada's collapsing real estate market, make sure to like this video, share it with anyone who needs to understand what's really happening to Canadian housing, and subscribe for more in-depth market analysis. Click the bell icon to get notified.